Today, pop goes the prices. Hello again, it's Martin North from Digital Finance Analytics. Welcome to this post covering finance and property news with a distinctively Australian flavour. Westpac says that Australia's housing market boom is showing clearer signs of slowing, with sentiment pointing to a decline in turnover through the first half of 2022. More importantly, the medium-term outlook has shifted materially, with an interest rate tightening cycle now expected to see a broad-based correction phase begin later this year, continuing throughout 2023 and into 2024. According to Westpac's February 2022 Housing Pulse report, the housing market boom is showing clear signs of slowing, with sentiment pointing to a decline in turnover through the first half of 2022. The report detailed how inflation and labour market changes are shaping the view on interest rates, which will impact the property market. And there's also further divergence among the states. As lenders already began to raise rates ahead of the Reserve Bank of Australia's cash rate rise and house prices soar, a housing correction is now forecast for 2023 and 2024. Nationally, prices lifted 2.5% since November 2021, which was a fall from the peak of 7.1% in May 21, but still an annual gain of 21.1%. Westpac's earlier indicators forecast prices would lift in the first half of 2022 before flattening out and dropping in 2023 and 2024. But the extraordinary surge in prices has seen affordability deteriorate, with new projections now forecasting house prices will flatten by May this year, ahead of a move into outright correction in the December quarter. Overall, that would see a net gain of just 2% over 2022. And house prices are then forecast to fall 7% in 2023 and by a further 5% in 2024 before stabilising towards the end of that year. Nationally, the peak-to-trough fall of 14% is around the average of corrections seen historically, they say. And the report said housing will be collateral damage in the RBA's efforts to keep inflation on target over the medium term, as rate rises will have a direct impact on the borrowing capacity of buyers and their ability and willingness to sustain high prices. Westpac senior economist Matt Hassan said while housing affordability has continued to weigh on buyer sentiment, interest rate considerations have yet really to impact. Sentiment-wise, virus developments have again only had mild impacts, albeit with developments a little more unsettling for those in states that have had yet to experience significant COVID outbreaks. Housing-related sentiment has been mostly unaffected except for a mild and brief loss of confidence around jobs that has now largely reversed, they said. Instead, the dominant themes continue to be around high and rising prices, stretched affordability weighing heavily on assessments of time to buy, but price expectations still actually remain quite bullish. Secondary considerations are mixed. Job security is in good shape, but risk aversion is still elevated, they said. More importantly, the medium-term outlook has shifted materially, with an interest rate tightening cycle now expected to see a broad-based correction phase begin later this year and continuing right through 2023 and into 2024, Mr. Hassan said. Our sentiment-based indicators are likely to capture this shift more fully in coming months. While the housing market shows signs of uncertainty, households, they say, have accumulated large financial buffers during the pandemic. The forced saving during the pandemic has led to an estimated $250 billion in additional reserves being set aside over the last 2 years, some $98 billion of which is sitting in mortgage offset accounts. If and how mortgage borrowers choose to deploy those funds is a key area of uncertainty, they say. However, as consumers have not experienced a sustained tightening cycle for over a decade, many may not be ready for the scale of the increase, which Westpac says will be around 1.75%. Additionally, the surge in fixed-rate loans in 2021 will see many borrowers facing a rate reset shock as the fixed period rolls off. Many of those were on extremely low rates, and they will see a significant step up when the fixed period rolls off, some potentially facing a rate reset shock in the order of 1 or 2%. The report said the state trends are showing a further divergence that is expected to remain a feature throughout the coming slowdown and correction phases. Three distinct groups are forming, reflecting the extent of affordability pressures and susceptibility to higher rates. New South Wales and Victoria sit firmly in the most sensitive group and are already showing signs of price momentum stalling. Western Australia and Tasmania look to be a little less sensitive, with a milder slowdown to date, and other factors suggesting they will be less susceptible to weakness. And Queensland and South Australia already stand out as likely to be the least sensitive, with price momentum accelerating in recent months, tight markets, and more headroom around affordability. Mr. Hassan said different states fall into three distinct groups: most sensitive, less sensitive, and least sensitive to affordability pressures and higher mortgage rates. While performance will vary, the common shock of a sustained rise in rates will impact all markets over the next few years. Housing will in effect become hostage to outcomes across the wider economy, with prospects resting heavily on how successfully policymakers, the RBA in particular, guide Australia through these looming challenges, Mr. Hassan said. Now, a couple of points there. The first is the buffers argument is, of course, spurious insofar that, sure, the money exists, but it's not equally spread across all borrowers. There are a massive number who have no savings even now. And secondly, of course, the real impact of interest rates are unknown until they happen. But a lot of sentiment could change quite quickly because people will tend to hunker down before the rate changes come through, knowing they're coming. And I do believe that the sentiment is already on the turn, as, by the way, are home prices in a number of locations. Elsewhere, ANZ's head of retail and commercial has criticised silly pricing in the home loan market resulting from intense competition. Addressing journalists in a media briefing on Tuesday, Mark Hand, the ANZ Group executive for Australian retail and commercial banking, reflected on the bank's recent movements in home loans. ANZ's last financial results showed that its mortgage book fell by $3 billion over the last 6 months, that's to the 30th of September, to a total of $278 billion, although their portfolio was up by 1% year over year. More recent APRA data shows the bank's owner-occupier loan book dipped by $200 million in December to $173.5 billion, while its big four rivals had otherwise managed to climb. On the other hand, ANZ's investor loans picked up by $100 million to $87 billion at the end of 2021. While headlines had zeroed in on ANZ's home loan balance diving, Mr. Hand said that media outlets had missed that the group needed to produce profit in a market where competitive pressures had steadily risen. Even while its home loan book was squeezed, ANZ had managed a 65% surge in cash profit during the financial year 21, up to $6.1 billion. At the end of the day, we're a company and we have shareholders, and so we have to watch that balance between volume and returns very closely, Mr. Hand commented. And personally, I thought that the market had gotten to a point where there was some pretty silly pricing occurring, where banks would be writing deals and not making money. And quite frankly, that's irresponsible for your shareholders, he said. In the recent reporting season, multiple banks have tracked falls in their net interest margins, and they've all pointed to competition in the sector for eating away at their profitability. Mr. Hand noted that there had been such fever pitch in the past year that he thought banks had overstepped and had been too aggressive on pricing. As that began to slow, volume and rates came down to ultra-low levels, and the matter evolved into an issue of refinancing. So there were banks trying to steal customers from other banks and putting really good offers, particularly around the fixed rates. And we saw some incredibly fixed rates below 2% at one point, Mr. Hand said. Having customers getting those sorts of rates, it makes sense that it creates a level of churn in the system and encourages customers to look around, because in a time where it's so uncertain because of COVID, we didn't know what was going to happen to the economy. ANZ, though, has aimed for a rebound in its home loan book. Chair Paul O'Sullivan, Chief Executive Shane Elliott and Mr. Hand have all previously outlined efforts to slim down stretched broker turnarounds, which reportedly had reached as long as 40 days. The bank has recruited and trained staff for its loan assessment processes. It's cut down on requirements for applicants and invested in automation. According to Mr. Hand, simple loan applications from brokers are now seeing turnarounds of 3 business days, while complex deals are facing a time frame of around 8 days. The bank's backlogs are down to under 2 days' worth of work, and no customer has been in the system for more than 14 days. It's also simplified its product offerings, recently scrapping its break-free packages, which allowed customers to bundle their home loans with other products, such as a credit card or offset account. I'm still in the boat where we want volume. I would like to grow, and for our shareholders, I think we should be growing and becoming a bigger business. Mr. Hand said there's a benefit in scale. The bigger scale you have in the business, the more benefits you can provide to your customers, because the more you'll have to invest in your systems. However, the executive insisted that the bank did not chase scale or volume at a cost of returns. And meanwhile, if the housing market does slow down in the coming 12 to 18 months, Mr. Hand expects competition for new and existing customers in the mortgage market to continue. And freshly appointed General Manager of Retail Broker Natalie Smith, who commenced her role this week, is expecting to see improvements in ANZ's home loan outcomes. Mr. Hand said Ms. Smith was also considered a process specialist after she led the transformation of the commercial bank. And the commercial experience is expected to bolster her in dealing with ANZ's higher proportion of complex loans. While CBA has a higher share of pay-as-you-go loans than ANZ, Mr. Hand said his bank, similar to NAB, receives more commercial loans, which adds to the complexity. A lot of the changes we're doing have been around how we think about a commercial customer as a home loan customer as well. Of course, those customers are incredibly valuable to banks because they tend to have their business lending with you and their mortgages with you, Mr. Hand said. They are incredibly valuable customers, but they are more complex and more time-consuming to do. Now, a couple of observations. The main reason why ANZ's profitability was extended this time around was because of reduction in provisions, but they didn't bother to mention that. And, of course, trying to justify lower market share because of better commercial management is an old trick in the book. So I'm not totally convinced by that either. That said, ANZ was clearly off the pace and needed to do something about its processing systems. The bottom line, though, is this. As Westpac says, it looks as though momentum in the mortgage industry and house prices is going to ease. And so to that effect, all of the banks are going to be under intense pressure at a time when funding costs are likely to rise and the number of new loans coming through the door is dropping off. It's going to be fun times ahead, and I suspect that many of the major banks are going to find that it's going to be quite uncomfortable because what they've all done is to essentially bet their future on more home lending at a time when more home lending might actually be evaporating. Now, if you're buying your home in Sydney's contentious market, you don't need to stand alone. This is the time you need to have Edwin Almeida from Ribbon Property Consultants standing alongside you. Buying a property is both challenging and adversarial. The vendor has a professional on their side. Emotions run high, price discovery and price transparency are hard to find, and then there's the wasted time and financial investments that you make. Edwin understands your needs, so why not engage a licensed professional to stand alongside you? With RPC, you know you have experience, knowledge, and master negotiators looking after your best interests. So shoot Ribbon an email at info@ribbonproperty.com.au, and if you use the promo code DFAWTW/Martin, you can get a 10% discount offer. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.